We're living the stream here in Brooklyn. We are in New York City, and you are watching Talkenomics live. We are streaming to you live on several different platforms. And what's unique about this program is this is the live stream where we talk about all kinds of topics as they relate to your money and investments and finance. We sometimes go a little bit far from that, but right now we're talking about the markets, and you get to ask the questions. Take a look at, if you're on X, for instance, you can put in a comment because we will talk about what you want to talk about. We will also answer your questions because we have people coming into the stream who make their living actually talking about and having to earn a living based on the things they say. I'm going to bring into the stream in just a minute our guest tonight. It's David Nelson, and you've seen him on other programs. But before I tell you more about David, let's see where the markets were today, because this was another down day. It wasn't catastrophic, but when you take a look, the Dow was off not even 0.5%. It was down 137 points. NASDAQ was off 0.5%, more of the AI tech scare. We're going to be talking about DeepSeek. Those of us who are old enough, I keep thinking about, what was it, Deep Thought, the computer from The Hitchhiker's Guide to the Galaxy. And the answer is 42. And the S&P, it was off by about 0.5% today, down 28 points. So let's keep that in mind as we look forward, because it's all about going forward. What's in the past, we cannot change. And with that, I want to bring in not only a very respected analyst and strategist, but a friend of mine, David Nelson. He is the chief strategist at Bell Point Asset Management. He is also a pilot, and he was in a band many years ago. Those of us old enough to remember the Turtles can talk about what that was like. But David, it's good to have you here. I know that people have seen you on CNBC and on Yahoo Finance and on Fox Business and several other platforms. But I just got to ask you real quick. You're the host of The Money Runner, which has almost 35,000 subscribers. You do this every day. If there's one takeaway that you have about investing and markets, what would that be?
And for me, Adam, by the way, thank you for having me. It's great to be here. You've been a friend for a long time, and I really miss some of those days. But for me, as an analyst, as a portfolio manager, and just an avid investor, it's about what's working, what isn't, and what's next. And we have to be able to change sometimes at a moment's notice.
And it's about change, because some of us, when we see markets start to go down or we get freaked out by like what happened with DeepSeek, I keep wanting to say deep think, but DeepSeek, there's a panic to it. But when you're old, the nice thing is what goes up does go down and then goes back up again. And you know to just take a deep breath and look the other way when there's a real fall, but there hasn't been a real fall. Let's talk about what all of this means in the terms of Mag 7 and some of the stocks that reported today. Because at 4 o'clock, we were all sitting around our computers. The pontificators on television were getting ready for Microsoft earnings, and they were the first one out. And it was a beat. Microsoft beat on revenue, $69.6 billion. They beat on earnings per share. If you go into some of the even more generic or deeper dive into where they performed, and we have a graphic that we can show you. I mean, it's all about the cloud and AI for Microsoft. If you look at that, their AI business annual revenue run rate, $13 billion, up 175%. Cloud revenue up 21% year over year. And the stock right now, after they reported, is falling. I think it's down like about 5%. David, why?
Well, all those great numbers you just gave us were backwards looking, all right? And unfortunately, stocks are about what's going to happen tomorrow. It's not about what you did for me yesterday. It's about what are you going to do for me tomorrow. I suspect somewhere in there's some disappointment, either in the Azure numbers, or even some of the cloud numbers, or even some of the AI metrics. One of the things that I'll be looking at when I dive into this report in the morning is I'm going to be looking at the CapEx line. Mm-hmm. They had said, actually it was the vice chair just a couple of weeks ago, startled the market when they said they were going to have a CapEx that was going to be significantly higher than what the street was talking about. And I actually talked to a friend of mine, Dan Niles, about it. And he said, don't fall for that, because they don't really, the CapEx numbers that they keep on their income statement, they're in a different place. You got to really go through the notes and see what they're saying here. But there's probably something they said that's causing the stock to be down 5%. That's a pretty big beat.
I'm sure too the hangover from DeepSeek is going to be part of questions they're probably getting on the earnings call is, why are you spending that money? What is the real return on investment? And that I set that up because Satya Nadella actually talked about the ROI, and here's a quote that he gave in the earnings release. He said, "We are innovating across our tech stack and helping customers unlock the full ROI of AI to capture the massive opportunity ahead." And the next question for investors who might want to buy Microsoft, or if they're thinking about selling Microsoft, David, is where do they really stand with AI after the upset earlier this week with what may be a legitimate threat out of China?
I think, I had to dive into the DeepSeek issue. And frankly, a couple of weeks ago, I didn't even know who they were.
Mm-hmm.
A lot of this information came last week. But by Friday, I was deep into it, and I actually watched a documentary on the company, and I had this sinking feeling over the weekend, kind of like what I had when I first learned about COVID in late 2019. This could be a problem, and it turned out to be that way. And certainly the whole weekend, everybody was looking at that, and we had, of course, the big sell-off on Monday. But here's what we know so far: Liang Wenfeng, he's an AI quant. He's also a hedge fund manager. He started this AI startup, and they seem to have built a very competitive model, much like ChatGPT, and in some ways even rivals ChatGPT, but at a fraction of the cost. And when I say a fraction of the cost, like 100x cheaper.
Mm-hmm.
But that's what they're telling us, and not everyone is convinced of that. I actually looked at a research report from Keith Malik,
mm-hmm.
who's a Citigroup analyst. And he says the only things we really know for sure is that they're charging a lot less. We really don't know what they spend. But the one thing for certain that we know is this is a real model. It's extremely powerful. And some of the brightest AI engineers out there have verified it. And you're going to see a lot of companies start to use some of what they found inside this DeepSeek model.
Okay, but is it any good? So it took me 2 days to get an account with DeepSeek because they were under the cyber attack. And then this morning when I kept trying to test it, it kept telling me the server is busy, the server is busy. Finally, this afternoon, I was able to get in. And what I did was I asked it the question that I asked other AI platforms which I use. And its output was deficient. It wasn't equally as good as the other platforms in its output. So I'm trying to comprehend and understand why everyone is going gaga for this, other than the fact that it's cheap. But remember, you could buy, what was it in the 80s or in the 90s, a Yugo. It had 4 wheels and an engine, but the darn thing wouldn't go anywhere. Is DeepSeek real?
It is real, but I think a lot of what they're telling us is not real. And they certainly don't have the infrastructure to handle the kind of traffic you're experiencing that right now. But apparently within their model, they are doing some things in inference. And inference is what happens after you've trained the model in the first place. It's the actual processing of a task. You go into ChatGPT, mm-hmm. you ask it a question, you ask it to do something. That's inference. And apparently what they're doing on the inference side is going to be adopted by a lot of other companies. I think Mark Andreessen kind of put it pretty well. A lot of people are calling it the Sputnik moment,
right?
For AI, and there's a fear that we're going to be spending a lot less, and hence a lot of these stocks have to come down. I was a kid when Sputnik happened, and I remember back then we were afraid that we had lost the space race. It was quite the contrary, and the amount of spending that happened over the next decade speaks for itself.
Before we go on to the other subjects, I have one more question for you, but I want to remind everybody, you can ask David questions. Just put them in to the chat. Let us know what you want David to answer. It can be about Microsoft. It can be, we're going to be talking about Tesla in just a second. It can be about DeepThink. It can be about anything that you want from someone who lives this every day. My final question on Microsoft to you, David: buy, hold, or sell?
I own the shares. I haven't decided whether I'm going to reduce the position. I've reduced this position a couple of times in the last 6 to 7 months because of some of the concerns I had. And frankly, you can just look at a chart. It's the worst performing in the Mag 7 probably over the last year.
Mm-hmm.
That says a lot. Price price is truth. And when you see a stock underperforming, it's likely doing it for a reason. The valuation was a little tough. And frankly, for a few of the Mag 7 stocks, it's tough to make that argument on the valuation side.
And we can't blame Ballmer anymore for it. I'm thinking,
You
remember
can't
peak
blame
oil?
Steve anymore.
Maybe we have peak tech right now. Let's keep talking about AI, but I want to, in the context of Tesla, let's bring up what Tesla did. Because Elon Musk, it's whatever he touched just turns to gold apparently. But when Tesla reported earnings right after the bell, the revenue was 25.7 billion. That was a miss. The expectation was 27.2 billion. The other issue regarding Tesla was that I watched this. There was a sell-off in the aftermarket right after they reported, and then it shot back. And I believe right before we came onto the stream, Tesla shares were trading higher. And there you go. Aftermarket, they are trading higher. So why do you think Tesla right now is trading higher? And I got plenty of follow-up for you.
And I really don't know the answer, but if I was going to guess, it's probably something to do with robotaxi. He probably said something positive to that end. And in the end, that's what people are buying here. It's not just about the AI. Nobody's buying Tesla because they make EVs or the number of EVs that they make. It's the idea of the robotaxi. And the robotaxi is important for the following reason. Full service, I guess it's full self-driving is what they call it, FSD. That's going to be a subscription model. And once you make something a subscription model, valuations go through the roof.
Back
People will
up.
pay anything for that.
When you say subscription, I'm thinking, I'm old school. We only cut the cable, we pulled the cord last year. What does subscription mean?
Well, it means the software that's needed to drive this thing, you're going to subscribe to it. It's not just going to come in a box. And we've seen how that revolutionized the software industry over the last couple of decades. Think back to years and years ago when Adobe did it. Adobe used to sell their software in a box, and they charged a certain amount of money. And then they decided to change to a subscription model. And at first, the stock was hammered hard because it meant a big loss of revenue and earnings early on. But the subscription model, people will pay a lot more for a company charging you, so much a month, $25, $30 a month. And in the case of this, it could be as much as $100 a month, or maybe even more.
It's a more stable revenue stream. I mean, if I'm
a stable revenue stream, you just said it. That's it.
New York City, if I own a stable of robo-taxis and I have to pay a subscription for each taxi that has to be updated as the software gets updated every 6 months to a year, my investors know that that revenue stream is going to be coming in. It's Netflix. They're going to overcharge us.
It's the Netflix model, and people just pay a much higher multiple. Now, the multiple on Tesla is it's through the roof. It's hard to justify Tesla on a valuation metric, but if stocks only traded on valuation, Apple would probably be trading at around 80.
Okay. So let me just ask you real quick, because you went to town on Apple, and we're going to be hitting that after we take a break. But with Tesla, I realize that the robotaxi is the play here, but could you take this subscription and the software, and would it be applicable in a non-Tesla robotaxi vehicle? Is that where that might be headed? You can watch Netflix on any kind of monitor. Is that going to be the future for Tesla's robotaxi software?
I don't know the answer to that question. That's a great question. I hadn't even thought of it in that context. So you're suggesting that they would license it out?
Why not? I mean, you're limited. If you only license it to the robotaxi that you're building, then you're limiting your potential for growth. But if you license it to other vehicles out there which have the right technology, you can sell the hardware that they'll need, but then license the technology.
I think the difference is that there's a hardware component here as well. In addition to that software, which they could license out. What about all the cameras? What about all the other technology that's needed to do this? Everybody's got a computer. Everybody's got a TV. If you standardize cars, then maybe you can get away with that. But for now, I think that's going to be a big leap, at least in the next couple of years.
All right. We won't pick on Elon Musk right now. Real quick, before we hit break, we had the inspiring, the no-brainer of the day, the Fed decision, the FOMC. They held interest rates. That was not the surprise. the street seemed to be upset with that maybe inflation is under control. What did you take away from Powell and his gang?
It was kind of a push, like you're at blackjack. It was a push. They don't really know what they want to do yet because the data that they're getting is a little bit confusing for them. The economy is still kind of humming along. This doesn't seem to be a problem as of yet. Inflation is kind of going sideways. It kind of stopped going down. They know that the rates where they are right now, they are restrictive. They are clearly restrictive in that territory. But the one thing for me as an investor that's changed in the last 4 or 5 months, think back to September when they first made that 50 basis point cut. We were looking for, probably a half a dozen cuts between then and the end of 2025. We're going to be lucky if we get one, maybe two. That changes the investment landscape, and suddenly you're in a different ball game. And the whole idea that everybody was going to make money betting on the whole yield curve and have a very strong bond rally, it worked for a few months and then it just evaporated.
But there's going to be a lot of pressure from the administration for Powell and gang to lower interest rates. Do you think they'll ignore it, or do you think they'll succumb to it?
President Trump can go after Jay Powell and he can yell and scream. Look, everybody does. Senator Warren, how many times has she come out hard against Jay Powell for being too restrictive? So the president has a right to speak, but in the end, Jay will do what he's going to do. But for me, Jay is not the problem. The Fed is not the problem. The problem is the long end of the curve. And Jay doesn't have a lot of power there. And 10-year yields have a much bigger effect on the overall economy. Think of all the consumer credit that is priced off the 10-year, certainly mortgage rates. It's going to do nothing for the housing market if he lowers rates and 10 years rates actually go higher, which they have. That's a bigger problem. And rates on the long end are going up for a completely different reason.
I had a discussion today with a financial analyst about what's going on with rates. And what really blew me away was, short term to, if you're looking at a 6-month treasury to 2-year, it was essentially the same. The yield was essentially the same. It's just flat. And I don't follow, the rates as closely as I should, but do you expect any change in that going forward?
I suspect that rates are going to move higher. I expect 10-year rates. I would say in the next few years, it's not going to surprise me to see 6% in 10-year rates. And the only thing that will change that, Trump has a shot at it. I don't think he'll do it. But if we can change the trajectory of the deficit, right now the deficit is 7% of GDP. If we can just somehow in the out years change the trajectory of that to something less than that, then I think the long end of the curve will ease up. But right now, there's a lot of forces out there that are looking at the United States, they're looking at the size of that deficit, and the risk-free rate just doesn't look as risk-free to them as it used to. And we also have a lot of hawks out there that are, very hard against the US dollar as the reserve currency. BRICS, which used to be just Brazil, Russia, India, China, and South Africa, is much bigger now. Now you have Iran and other countries out there. They're not our friends. And a lot of transactions are taking place in non-dollar currency. That's going to put pressure on us.
All right. Our guest tonight is David Nelson. He's the chief strategist at Bell Point Asset Management. We're going to take a quick break, but remember, you can ask David your questions about investing. You don't have to stick to the topics that we're discussing. He is loaded for bear and ready to answer your questions. We're going to be back in 1 minute. All right, we're jumping back into the stream with David Nelson, and we are talking about where to put your money. David is the host and the creator of The Money Runner. You can watch The Money Runner on YouTube. He also has a Substack. David, what is people might want to subscribe to your Substack. What is the address for that?
Sure. It's DC Nelson 123 at substack.com.
All right. Let's talk about your most recent Money Runner post, because I'm one of those people who is held hostage by Tim Cook and company at Apple, because many years ago I bought an Apple device and now I'm locked into their ecosystem. And for me to leave Apple, I mean, at work I use Microsoft and PCs and I curse and I yell. And at home I use Apple and I'm locked in and I curse and I yell. And I would say that I like Apple products. But today you said the emperor has no clothes. You were talking about Apple. And in the United States, I mean, I think we're gaga for Apple. But elaborate on that, because they're going to report earnings tomorrow, and you do not expect to be impressed.
I don't know what they're going to do with this number. Even if they beat the number somehow magically, and even if they guide, the next quarter better than expected, the stock may pop on that. But it's not going to change the trajectory of a company that was once the most loved company on the planet. And I think that's starting to abate, because I think certainly a lot of tech enthusiasts, a lot of portfolio managers, certainly a lot of fans, and a lot of people who buy their devices are less thrilled with what they're seeing. Watching innovation at Apple today is like watching a glacier move. I
have a piece of the glacier, by the way. It's an iPhone 16, and you are correct.
It's happening, but you just can't see it. And this incrementalism that's built up over the last decade, it reminds me of what they used to do with cars back in the 50s. They would move the fins on the cars, but the basic car hadn't changed. And I would venture to say that my iPhone, which is an iPhone 14, isn't a lot different than an iPhone 16. And as a matter of fact, I went into the store and I was not impressed.
I had an XR. An iPhone 10, and my iPhone 16 it has a better camera, but quite honestly, I don't see any difference in I shoot video on it, and that's nice. But the AI, I'm not impressed, and Siri voice dictation is still kind of like Emily Latella from the old Saturday Night Live, youth in Asia. Why did they go to Asia? I mean, Apple, just get your act together. But if you saw, I think we just pulled up the stock chart for Apple. The street is expecting big things, and your counterparts at other firms make a big deal over the replacement issue, because people like me have to buy their replacement Apple product. Are they correct? Are we going to see that as we look backward? Did that happen in the fourth quarter, do you think?
We've been counting on that for the last 4 years. That's been the narrative, that the upgrade cycle is happening. And as a matter of fact, if you look at that chart and you look at that run, to the all-time high in December, that was on the heels of an announcement that they made that they were introducing the AI and it wasn't quite ready yet, but the upgrades were going to improve it all, and everybody was going to have to buy a new phone, and it just made all the sense in the world. But to your point, people went in and actually bought the phone and it wasn't there. And so now we're all talking about the iPhone 17. Well, we had that conversation at the iPhone 15 and the 14. We keep looking for the upgrade cycle. It hasn't happened. I think there's a bigger problem here. Apple has to start taking risk. And incrementalism, when you're a company this large, they're trying to protect the top and bottom line, and they're trying to just not make any mistakes. But it's kind of like watching your favorite football team. You're ahead, and you're in the fourth quarter, and they put on the prevent defense. All right, and the other side scores, and they win the game. That's what's happening to Apple right now.
You just described the Bills in Kansas City. They need to take some chances. I apologize I interrupted you, but you said that in your Money Runner post that they need to take some chances, and it doesn't seem like they have. But they've taken chances in the past and missed. Remember, they were going to build a car.
Yeah, I went back to look at that, and I was astonished to find that they lost $10 billion over about a decade on the Apple car. That's nothing. That's a rounding era at Apple. They clearly did not invest enough. They make $10 billion in free cash flow in about 5 weeks. That's not a major risk taking. Now, to Tim Cook's credit,
Yeah.
he's taken this company and through his operational excellence, the supply chains, everything he's done has taken this company. Think back where it was in 2011. It's gone 10x.
I'm going to tell you,
tutelage.
Real quick, I'm going to take you back to 2014. I got a photo of Tim Cook. When I was at Fox, we were covering Sun Valley, and I was trying to get him to talk to us, and all of the big billionaire and the very wealthy CEOs. He blew me off. He wouldn't talk. It's like, get out of my way. I don't want to. Yeah, he wouldn't talk to us. It was okay. Rupert Murdoch blew us off, and we were his network, so it's okay. But Cook and Company, it's just I will tell you that I have a love-hate relationship with my Apple products, but you're right. I'm not impressed with the iPhone 16. But I was one of those replacement people because the XR, it wasn't going to be able to upgrade. I've got a question, though, from a viewer. Betsy has written in and is asking, is there anywhere exciting for a tech investor to look right now? Because it does seem like so many things are very expensive when you're talking AI, when you're talking Apple. So how would you answer her?
It's tough. Valuations are stretched, so we live under that matrix. But if I look down at my tech screen where I'm looking at, say, 50 to 60 different securities in there, one thing kind of stands out. Most of the biggest moves are from companies that are a little bit smaller, a little bit more entrepreneurial. They're a little earlier in their cycle. A lot of networking companies out there have done very, very well. And a lot of these companies are up, 15, 16% year to date, when a lot of the big guys, with the exception of maybe Meta and a couple of the others, are actually, down year to date. Mm-hmm. So there are things out there. And make no mistake, AI is a big deal. Mm-hmm. This is the most important investment theme in my career. I'm quite certain of that. It is real, and it's going to get more real. But we're going to go through this churning effect. Mm-hmm. And we did this all through the 90s. Think about back to when people were investing in Cisco in the 90s. Cisco had probably 3 or 4, 30 to 40% corrections in the stock. And then it went another 300 or 400% before it finally peaked out in 2000, because the internet was going through its ramifications. AI, in my estimation, is still in its early stages. So there are things out there.
And we did not talk about Meta earnings, but we should. Everyone's talking about the genius of Zuckerberg and Meta because they do believe in the open AI platforms, such as DeepSeek. I keep wanting to say DeepThink. But what's the play, though? Where do you go? How do you find the smaller company out there? Because these are expensive stocks.
That's hard, and this is where active management comes in. One of the things that I like right now is there are a lot, especially in the ETF world, there are a lot of ETFs out there that are now actively managed. I actually think we've entered into an age where active management is going to start outperforming the index buyers, because I feel that the world has been democratized. Mm-hmm. I think the investor at home today has almost as much information as a professional like myself, if they're willing to dig down and get to it. When I first started in this industry, information was a premium, and it might take a day or two, sometimes a week, for important information to filter its way through the market. Today, it happens in a microsecond. So professionals don't have any more of an edge than somebody at home watching the show out there, and you got to do the grunt hard work to find those names, but you got to do it.
Okay, so I'm very conservative when I invest, although I've lost plenty of money trying to do some startup investment. But I would say to you, I'm one of those index investors. And what I keep hearing for people like me, Warren Buffett says people like me should index. I also know that the returns we got in the S&P 500 over the last 2 years were driven by the Mag 7, and that may not materialize this year. So what I'm hearing you say is those of us who do play the index, whether it's the Vanguard Index 500 or the Fidelity Spartan 500, that's the wrong play, or am I misunderstanding?
what I'm saying is there are actively managed funds out there. I'm not a real big fan of static things that are like, this is equal weight, this is rotational, or the large cap index. I think there are portfolio managers out there like myself, and there are many of them that you can choose from today. Go to your Morningstar reports and look at what some of these guys are doing. You're seeing some pretty impressive numbers. And I think that what's changed is in part the Fed normalizing the yield curve. It doesn't seem like an important thing for stocks, but it is. The Fed, when they kept rates at zero, when rates are zero, the tide lifts all boats. There's almost no difference between anything because money is free. You'll pay almost anything. And now that isn't the case anymore. And there's a lot of active managers out there that are doing quite well against the indexes.
So let me, I'm going to wrap up, but I want to ask you two more questions. First, someone who's 30 or in their 30s, what advice would you give to them about what to keep your eyes open for in the next year, the next couple of weeks, but the next year as far as where to put your money?
We don't know what we don't know. And anything I could tell you right now, I've got no crystal ball that's going to tell you if some black swan event is going to happen in the future. We live with those threats all the time, but you can't invest thinking about that. You've got to be in there. If you're 30, virtually all your money should be in a risk asset, and you should forget about it and just keep plowing ahead with it. But if you're approaching retirement, putting all your money in stocks is financial malpractice. You cannot do that. And you're going to need some other asset classes. And now there are other things you're going to do. It's not going to be just the typical bond portfolio to offset your equity risk. You're going to have to do something, but you can't have all your money in stocks.
So that was the follow-up question. So let's say you're 56, 57, hint, hint, and you're approaching your retirement, and your split is roughly 80-20, 80 equity, 20% fixed income. Is it time to rebalance that?
That's probably high. Yeah. I'd pull that back 70 to 60. And frankly, right now, given what's going on, what I think is going to go on with the yield curve, for the bond side of the portfolio, if you want to be ultra safe, put it on the short end of the curve. 1 to 2 years, no more than 5. Ladder it out, go out to 5 years, but you'll do quite well. And if you have a fairly steep correction, if that happens, you're going to be able to weather it. If you had a 50-50 portfolio over the last 2 years, you did pretty well.
Okay. I just want to let you know something, because at the beginning of the program, I mentioned that we keep it finance focused, but sometimes we deviate. Next week on Wednesday, Anthony Scaramucci is going to be the guest. If you had a question for the Mooch, David, what would you ask him?
Anthony is I've always wanted to know the backstory on Trump. I hope you ask him that.
Okay.
That he's had a metamorphosis. He's gone from one side to the other, but he's a survivor. I'd also want to know about crypto. I'd ask him about what did he learn when he went down and saw Sam Bankman-Fried. That's going to be an exciting show.
Yeah, well, I appreciate you're helping me plug that. But we have Anthony Scaramucci next Wednesday, February 5th on Talkenomics, 7 p.m. Eastern. David, you get the last word. Is there anything you want to leave us with as we wrap up?
Wow. I guess the biggest risk is not taking one. And that was something I put in the article. And it was actually a quote from Mark Zuckerberg as well. Sitting on the sidelines, it feels good. And when the markets go down, you're not getting hurt, but you're going to have to take some risks. You just got to do it with some intelligence and in the right proportions. There's nothing wrong with a risky stock, but you got to size the position to be appropriate for that level of risk.
All right. And just a reminder to all of you, Talkenomics, every Wednesday, 7 p.m. Eastern. You get to ask the questions. So just make sure you're here and you can ask the Mooch questions. We've got lots of people lined up coming up every Wednesday, 7 p.m., because we jump into the stream from Brooklyn, New York. Have a great evening, David. Thank you very much. And remember, you can get David at The Money Runner. Have a good night. David,